Happy New Year! Markets closed 2021 strongly, with global equities rising nearly 4% in December, only to see them give back most of those gains as 2022 began. Bond investors, in contrast, saw the pain seen throughout 2021 continue in December as risk-free yields rose to ring in the new year. A shifting Fed policy agenda roiled bond markets in recent weeks, and is consistent with our outlook for U.S. 10-year yields finally breaching 2%, and even German Bunds moving above 0% for the first time since 2019. Credit spreads should finally succumb to rising Treasury yields, with corporate bond investors receiving not only below inflation rates of return, but in 2022 also coupon minus rates of return in the year ahead. For this reason, we have begun to rotate directionally away from fixed income and increasing allocations to fixed income hedge fund strategies such as long-short credit and credit arbitrage. This should shield investors not only from further rises in yields that we expect in 2022, but also widening credit spreads that is typical at this stage of the economic cycle. Fortunately for investors, a tightening Federal Reserve has historically not been troubling for equity investors. U.S. equity investors have seen positive returns averaging nearly 6%, with no periods of negative returns during the Fed tightening cycles since 1990. Admittedly, drawdowns during those tightening cycles have been deeper than seen during the easing cycles, suggesting to us that alternative strategies, including long-short equity, that focus on high-quality, high-visibility earning streams, should allow investors to offset this likely increase in volatility ahead. Indeed, equity investors can look forward to a tailwind from the start of the earnings season in the weeks ahead. Remember that 85% of the gains realized in 2021 have come during earnings seasons, as companies have consistently delivered ahead of expectations. With earnings expectations still too low, we expect the coming weeks to see upgrades, serving as the catalyst for equities looking into February. Thus, as we start 2022, investors should focus on shielding their portfolios from increasing volatility expected in both fixed income and equities. In fixed income, this suggests a focus on actively reallocating their exposure to shield them from rising rates and widening spreads. In equities, a bottom-up focus on high-quality, high-visibility earning streams can be paired with volatility-suppressing approaches like hedge funds and structured strategies as global equity markets move into the next phase of the economic cycle. For more information about how we're preparing for this new Fed policy regime, please visit us on ubp.com.